Good day, ladies and gentlemen, and welcome to the show on this Friday, the 26th of February 2021. Thank you for tuning in. I'm going to do a quick primer right now, help you guys come up to date real quick on what's happening in the bond market and explanations. And so let's start the charts right here and take a look at what's going on. First thing I want to talk about is this 10-year. Now, the 10-year is so important because it is the bond which most debt is based off of, is the 10-year. And what we see, this thing that's happening right now, it didn't start right now. It's been creeping up. It started in October. October, November, December, we see here. It's been creeping up. Then we move into the new year, January, February, and see it going up and up and up and up and up to where it is now. Now it's really shooting up, the 10-year. Well, the thing about bonds is you see this going up, people think, hey, the price is going up. The bonds work in reverse. When you see the chart going up like this, it means that the yield on the bond is growing larger. It means that the bond is falling. It's inverse. It works inverse. So what we see is a crash here, a crash beginning in the bond market. This is a crash. It crashes upside down from all the other markets. All the other markets crash when they go down. The bond market crashes when it goes up, and we see it going up here. So the bond market's crashing. That means yields are going up, and we see it shooting up here, and this is causing much alarm within the financial system right now, this shooting up in bond yields. Now, if we take a look here at the overnight repo rate, now this is a part of the yield. This is a part of the bond yields that the Fed controls. And we see going back to around April of 2020 or May of 2020, they smashed it down. The overnight rate was up around 1.75%, and they smashed it down, and it stayed smashed down all these months. May, June, July of last year, into the end of this year, and into 2021. But just on the end here, you can see that it's even went down lower. It's all the way down to like 0.6 or 0.7%. That's only 0.7%. Very, very tiny. It's near the zero bound, or near the zero margin. Now, this is the overnight rate. This is the rate. I'll explain to you what the overnight rate is. It says the overnight rate monetary policy. The overnight rate is one of the most important macroeconomic variables. Changing the overnight lending rate may also influence other macroeconomic factors, including the unemployment rate, inflation, and the economic growth rate. Central banks manipulate the overnight lending rate to implement their monetary policy. For example, if evidence of a slow economic growth emerges, the central bank can implement an expansionary monetary policy by bringing the overnight rate down to stimulate growth. Now, see, what's happening in this situation is they've got the overnight rate down near the zero bound. It's only just marginally. It's less than 1%. Way less than 1%. To stimulate growth. But it's not stimulating growth. The economy's dying. You know? But they're having to keep it there. They can't raise it because the little bit that we have in the entire economy would be lost if they raise this rate, this overnight rate. So they've already forecast. The Fed's already told everybody, we're going to keep this rate down low like it is now, maybe even lower, for the foreseeable future, in hopes that the markets would respond to that. You know, but no. We can see the market's falling anyway. Why? Is because the long end of the yield curve, the 10-year, the 30-year, and everything, is going up because the Fed doesn't have control over the long end. Not yet, they don't have control. And this is what yield curve control is all about. It's about controlling the long end of the yield curve, not just the overnight rate like they do now. They control this. They control the overnight rate. So I'll read a little bit more here. It says, by bringing the overnight rate down to stimulate growth, A lower rate implies that the banks can borrow the funds from each other at a lower rate. Subsequently, the banks can charge lower interest rates to their customers, making loans affordable to businesses and individuals. Therefore, businesses are able to obtain additional funding for various investments and expansion activities, while the purchase power of consumers also increases. Conversely, if a country's economic is overheated, in other words, the economy is starting to overheat, and there are signs of rising inflation, the central bank may enforce a contradictory monetary policy by increasing the overnight rate. Well, they've got to a point now where they cannot increase the overnight rate. In fact, they tried, and they failed miserably, and now they've got trapped. They're trapped, so they can't control that mechanism. They're having to keep these rates low, not only on the overnight rate, but all the way out the yield curve to the end of the yield curve. But they're not. The rates are rising on the long end. This is putting tremendous pressure on the economic system right now. And the economic system is actually starting to break under the strain of these rates rising on the long end of the yield curve. And that's what's happening right now. So there's an awful lot of pressure on the Fed. This is the reason why everything's falling off right now. You see silver prices, gold prices falling off, because treasuries become more attractive when the rates go up. In other words, when the treasury crashes on the long end of the yield curve, say the 10-year, it starts to crash, and the rate goes up higher and higher. Goes up to 2%, 3%, 5%, 10%. The higher it goes, the more attractive that bond is to investors, because it means they're going to make more yield. And so what does that mean for bonds? Well, when we see the 10-year go up high, or the 30-year go up high in price, bond investors are more likely to buy it, because once it reaches a spot where it's higher than the rate of inflation, and I would say the rate of inflation right now is probably somewhere north of 6%. Now, I know they say they're not even 2%, the inflation rate, but what's the real inflation rate out there? And so what these bonds in the long end are trying to do is they're trying to go up to match the rate of real inflation. Markets have a way of self-adjusting themselves. So these bond yields are trying to go up to match the rate of real inflation, which would be, for the 10-year, around 6% probably, or 7%. That's what they're trying to go to. And that's what they will go to if the Fed leaves them alone. They're going to find fair market value, which would be about 6 or 7%. The Fed can't withstand anything higher than 2% on the 10-year. So they're going to have to react. And when they're forced to react, everything's going to reverse in these markets, especially for what you guys are interested in. That's gold and silver. Let's take a look here at the silver price today. 26.12 is down $1.30 because of these rising yields. This is going to reverse, guys. When the Fed comes out there and they make a commitment, let me make this very clear, this is not quantitative easing. Yield curve control is not quantitative easing. It's a commitment by the Fed to put a peg to the yields on the whole end of the yield curve, all the way out to the 30-year. They'll put a hard peg where the yields can't go over that peg, and they can do that. But when they do that, we're going to see a reversal in the fortunes of gold and silver, and possibly cryptocurrencies, but gold and silver, because gold and silver are a financial asset that are very closely related to the U.S. Treasury assets, buying treasuries or buying debt, right? And they're considered to be a safe haven asset. Gold and silver safe haven asset, and U.S. Treasuries is considered. I say considered because I don't consider them to be a safe haven asset. But an awful lot of people out there, the vast majority of people, consider them to be the best safe haven asset, even though they're buying into a corporation that's bankrupt. A corporation that's so deep in debt they'll never be able to get out of debt. Still, The U.S. Treasury is considered to be a premier safe haven asset, and so is gold and silver. So they're like in a competition. Now, when the Fed comes along and says, okay, we're going to put a peg on the higher level, these Treasury yields start to go up too high, we're going to put a peg on it. We're not going to let them go up to match inflation so that you can actually keep up with the rate of inflation with the U.S. Treasury. That's not going to happen. Sorry, guys, we're putting a peg on it. We're going to keep those rates down. When they suppress those rates, they're suppressing the price of the bonds. Just like they've been suppressing the price of gold and silver. They'll be suppressing the treasuries. And you know what happens with suppression? Well, if they start suppressing the treasuries and keeping the yields way down low where a person is got a negative rate of return because inflation is higher than the yield on your treasury, then they're going to say, well, I'm going to buy gold instead. I was going to buy treasuries, but the Fed's now got this put on the treasuries, and the Fed has got a hard peg on them, and the price is not going up on these treasuries, and the yield's not going to go up any higher, and I can't make any money off of that. I'm going to go out and buy gold. Makes gold far more attractive. It just works the exact opposite what's been happening in the last couple days. Look, silver down at $1.27 today. 26.16, you can't get any. Or it's very hard to get any. What kind? You can see the manipulation right here in these markets. Okay, let's take a look at cryptocurrency today. We didn't do gold. We forgot gold. Let's take a look at gold. Every day I forget to do gold. Gold, $17.19 today. It's down $50. Wow, they're making a nice sale for you guys if you can get any. Nice sale on it right now. Okay, cryptocurrency today. Let me see here. 1,458 billion. 61.1% Bitcoin dominance with a Bitcoin price of 48,177. I can see something. Everything's turned bearish. Oil's turned bearish. Gold, silver's turned bearish today. But they don't like to sell their Bitcoin. They'll hang on to them more than they'll hang on to their silver short contracts. You know, they'll let go of their SLV and GLD an awful lot quicker than they'll let the price of oil drop and everything. But no, they're going to hang on to those Bitcoin. And you'll say, well, it's dropped a lot. Yeah, it has. But still, it's still hanging in there near $50,000. They don't like to let go of them, do they? That's because it's just like letting go of a gold coin. It's the same idea. A person has a gold coin in their hand, they certainly don't like to take it in and have to trade it in. It's the same way when they got a Bitcoin in their hand. They feel the same way. The Bitcoin hodlers. And they hate to let go of it. They would rather sell anything else. They'd rather sell their grandma's antiques than sell their Bitcoin. Let's take a look here at Dow Jones today. 31,247. It's down 155 points on the day so far. That's why everything's moving down. Because these treasuries moving up. The yield's moving up. I think the Fed's going to... I'll tell you, my opinion, the Fed's going to put a stop to this, guys. And pretty soon, too. I don't think they're going to let it get much... I think when it starts to get up around 2%, you're going to see the Fed take action. And I think it's heading in that direction. If the Fed doesn't take action sooner. Crude oil today, $62.31. It's down $1.22. Now here's a big signal, and I'm telling you guys, I give you guys a marker. This thing was down like 45 there a week or two ago, and it wasn't doing nothing. Wasn't doing nothing, and I told you guys, this thing can explode to the upside. And I said 75 is the mark when the credit markets start to become unstable. Well, look, it's shooting up. It shot up 12 points today. The MOVE index. And this means that we're right at the verge of the credit markets becoming unstable. 74.16. Something caught in my throat. Anyway, let's move on. U.S. Treasuries today. I think I swallowed the wrong way a little bit. U.S. Treasuries today. We're seeing falling yields, all except for the U.S. 5-year. But it's looking like it might do a little bit of a reversal later in the day. We're looking at 1.49 on the 10-year and 2.29 is it on the U.S. 30-year. But see, what happens is these yields go up. Like yesterday, they went up. And then you actually see buyers come in because the yields become more attractive. See? And then it reverses it, but it won't reverse as far as it went up. So the yields went up yesterday a higher amount than the reversal today. And this is what it's been doing. This is the pattern it's been doing for the last 6 months or so. Going back on the 10-year, if we take a look here, we can see that pattern. Let's take a look over a 3-month period. You see that pattern now. If you go in close, you can see it. They rise up to a new level, then they drop back down again. Then they rise up to a new level, and then they drop back down again. That's what's done right now. It's rose up to a new level, and it's dropped back down a little bit again. But it doesn't go back down as far. So we get higher highs, sort of thing, where they're buying in each time the yields pop higher. And the Fed's hoping that there will be a reversal on this, hoping against hope that it's going to go up and it's going to stop, and it'll reverse somehow magically on its own, because they don't want to do yield curve control. They really don't want to. But I say they're going to have to very soon. Take a look here at 90.79 on the dollar, and we see strength in the dollar. The strength in the dollar is coming from these bond yields again. So there you go, guys. You got your market report for today. Thank you guys for listening to my show. Hit that subscription thing, and then touch the notification bell. I need all the subscribers I can get. Tell your friends about my channel. I'd really appreciate that, And comment in the comment section. Love hearing from you guys. And we'll catch you guys in the next show. Bye-bye.